I'm Motley Fool Canada Senior Analyst Nick Seipel, and this is the 5 Minute Major. Here to make you a smarter investor in about 5 minutes. Today, we're discussing the latest wave of Canadian bank earnings and how we're thinking about the sector today. My guest today is Motley Fool Canada Chief Investment Officer Ian Butler. Ian, thanks for joining me once again.
Always a pleasure, Nick.
All right, Ian, we just saw a big week of earnings from the big six Canadian banks, RBC, TD, CIBC, all topping expectations. What are your key takeaways from this quarter? And is the worst of the economic worry behind us for the Canadian banks? These have been great performers, but there have been some concerns floating around out there leading into these reports.
Yeah, and I think it's great that we're finally calling them the Big Six. It's been the Big Five for so long, and I think Nationals finally worked its way into the mix. But on the earnings season that we've taken in, the first point I'll say is that a big part of what makes these companies such wonderful businesses is that they're very well diversified. We think of them as banks, but they offer so many more financial services, and this was on full display in this most recent reporting period when their capital markets and wealth management divisions were really driving the bus. Both RBC and TD especially posted massive revenue growth in their trading and wealth divisions, and that's of course been helped by a pretty red hot stock market, despite recent volatility. The surge, though, these divisions are very fee based. The surge in the fee based income perfectly offsetted some of the slower growth in their traditional lending businesses. So again, that's the great balances that these companies have. Another blanket that we can toss over the group is that credit fears so far have really appeared overblown. We're seeing a modest uptick in delinquencies for such things as auto loans and credit cards, but the numbers still remain highly manageable and well below crisis levels for sure. The banks are heavily provisioned, and their strict focus on prime borrowers especially has really insulated their massive domestic mortgage portfolios. And about mortgages, the 2026 mortgage renewal cycle, which is kicking off here, is actually proving to be and going to be a margin boost for these companies. We're in the final year of the major 5-year mortgage resets, going back to 2021 when rates were at sort of pandemic lows. Borrowers are now being renewed into at market rates which are much higher than those pandemic lows, and that's a boon to the bank's net interest margins, provided credit remains as it has. So really hitting on all cylinders.
Yeah, so with all the Canadian banks performing for the most part, well, it can really be tough to pick an individual winner. And really, a lot of these worries about the market kind of moving behind, as you said, moving through this mortgage cliff into a more sustainable market. So for those looking at the sector, how do you choose where to invest your capital across the Canadian bank opportunities?
For sure. And there's certainly times when a bank or two will stand out from the rest on a valuation basis. However, now I don't think is one of those times. So we see Royal Bank trades at a price to book ratio of about 2.6. That's on the high side of the group. And Bank of Nova Scotia, which has sort of been at the low end for years, but actually has performed quite well of late. So Bank of Nova Scotia trades at about 1.5 times book. That's the low end. But I don't necessarily think either could be classified as expensive or cheap just based on how the companies are performing in their business performance. So our view, and this has been our view, frankly, for years, is why we don't need to choose just one. And our vehicle to express this view, and several of our members only services, has been to recommend the Hamilton Enhanced Canadian Bank ETF. The ticker there is HCAL on the TSX. So this bank ETF, it provides equal weight exposure to all of the big six Canadian banks. It completely removes single stock risk of trying to guess which individual management team will outperform in any given quarter. And then in terms of features, the fund utilizes a modest 25% cash leverage strategy. This helps to amplify both your capital appreciation and dividend yield without relying on complex and risky derivatives. And HCAL pays a monthly distribution, currently yielding 4.24%, which is at the upper end of the dividend yield offered by all of the big six. I think Scotia's at about 4.24, and then every other bank is below that. I mean, traditionally, Canadian banks are a go-to for dividend lovers, and HCAL offers a very steady, tax-efficient, and enhanced passive income stream compared to waiting for the standard quarterly dividends that the individual banks provide. So I'll just add, it's been a wonderful vehicle for our members. for me personally, frankly, I own it. And I'll just add that over the past year, Canadian bank stocks have had a tremendous move higher. Dividends included, though, HCAL has posted a 67% return, and that's beaten every one of the big six. And that's the leverage component coming into play. When the banks are going higher, HCAL is going to do very well, and it has.
Yeah, past performance, obviously not a predictor of future results, but given these reports from the Canadian banks this quarter, pretty solid environment that these companies are operating in. Perhaps an opportunity to look at these companies in this environment where folks are all worried about AI and those sorts of things. Totally unrelated to that sort of market risk. Okay. That's all the time we have for this edition of the 5 Minute Major. Reminder, folks, if you want more stock ideas from us, click the icon in the upper right of your screen. Hope you'll join us next time. Until then, Fool on.